Welcome to Iron Financial, the place we come to forge stronger portfolios by stress testing what the market is telling us. Today we are cracking open Boston Scientific, ticker BSX. Now this is a company that just delivered what you can only call a phenomenal, record-smashing 2025. I mean, by all accounts, they basically built a skyscraper of a year. And yet, when they told the world about this amazing achievement, the market acted like it had found a giant crack in the foundation, and the stock just went tumbling down. So we're here to figure out why. Is this a real, genuine structural weakness, or is the market just getting spooked by a shadow?
Yeah, that really is the million-dollar question, isn't it? The numbers they put up for 2025, they look like pure steel. We're talking record revenue, incredible growth. But then on February 4th, 2026, the stock got hammered like a wrecking ball in pre-market trading. So Wall Street celebrates this monumental success by selling it off. I mean, on the surface, it makes absolutely zero sense. So what did they see that all the glowing headlines missed? What gives? That's exactly what we're about to dig into.
All right, let's get into it. Here's our blueprint for today's analysis. First up, we're going to tackle the market's violent contradiction, that immediate, brutal sell-off. Then, we absolutely have to inspect the performance engine itself. You've got to understand the sheer power that BSX generated in 2025. Once we've built up that bull case, I'm handing it over to our market skeptic to start searching for cracks. He's going to probe all the weaknesses the market seems to be so terrified of. From there, we'll examine the financial bedrock, the core strength of the balance sheet, to see if this whole structure can really handle the pressure. And finally, we'll weigh all the evidence and deliver the iron financial verdict. Is this a solid foundation to build on, or a fracture just waiting to happen?
Okay, let's jump right into the conflict, because this wasn't some slow burn, you know? The market's judgment here was swift, and it was brutal. We're talking about a company that just reported what their own CEO called an exceptional year, and the immediate reaction from investors was to basically run for the hills. This is where you get two totally different stories, the company's story of triumph and the market's story of fear. You know, what's really fascinating about this is the timing and the sheer scale of it all. A drop of nearly 10% before the opening bell. Look, that's not some minor tremor. That is a seismic shock. What this tells you is that the institutional money, the big players, they read that press release and their trading algorithms immediately flagged a huge problem. This wasn't some carefully considered strategic move. This was a gut punch reaction. The big money saw something that scared them, and they decided to shoot first and ask questions later. Our job now is to figure out exactly what they saw hiding in the shadows. And before we go looking for that crack, we have to appreciate the structure they built. Right? You can't possibly judge a potential weakness without understanding the incredible strength it's connected to. So let's pop the hood and inspect the engine. Let's look at the sheer force that Boston Scientific was putting out in 2025. Because believe me, these numbers don't just talk, they absolutely roar. This is the foundation that the entire bull case is built on.
Let's start with the cornerstone right here. Over $20 billion in net sales. Just let that sink in for a second. This isn't some small cap growth story we're talking about. This is a massive, global medical device titan that is operating at absolute peak performance. This number, all by itself, is like a fortress wall. It represents just immense market penetration and demand for their products all across the globe. It's the kind of top-line number that commands respect and establishes them as a totally dominant force in medtech.
Okay, now here's where it gets really, really powerful. Almost 20% reported sales growth for the whole year. For a company of this size, that is not just growth. That's a massive, massive acceleration. I mean, that's the kind of velocity you'd expect to see from a much smaller, nimbler company. To see a $20 billion behemoth putting up these kinds of numbers, it tells you that their strategy, their innovation, their execution, it's all firing on every single cylinder. This is the heavy lifting that builds empires.
And this right here just illustrates perfectly that 2025 was no fluke. Just look at this trajectory on the chart. This wasn't some lucky break. It was a calculated, deliberate climb. Every single year, they shifted into another gear, building more and more momentum until they hit this incredible peak. This is what a well-oiled machine looks like. So, 7% growth back in 2022. That's solid, right? Then they ramp it up to 12% in 2023. Impressive. Then they hit the afterburners to get to 18% in 2024, and finally they peak at nearly 20% in 2025. This is not a one-hit wonder. This is the result of a multi-year strategy, of market leadership, product innovation, all of it coming together in this incredible crescendo. This is what a winning company looks like on paper.
So where is all this power coming from? Let's look at the engines that are actually driving this thing. It's not just, diffuse growth across the board. The main engine, the absolute powerhouse, is their cardiovascular segment, growing at a staggering 18.2%. This is their core, their high-value business, and it is firing on all cylinders. And at the same time, their other major segment, MedSurg, is putting up a very respectable 11.7% growth. So this demonstrates a really balanced strength, with a clear dominant pillar doing the heaviest lifting.
And here it is, the capstone on the bull case. The CEO himself, Mike Mahoney, calls it an exceptional year. He gives credit to innovation and high performance. He is telling the market that this performance is the result of their winning spirit and that they are, quote, well-positioned to continue on our strong growth trajectory well into the future. This is just maximum confidence coming from the very top. So what you have is record sales, accelerating growth, dominance in key areas, and unwavering confidence from leadership. This whole structure looks indestructible.
Okay, that was a very, very impressive victory lap. The building looks magnificent, I'll give you that. But here at Iron Financial, we don't just stand back and admire the architecture. We get in there and check for structural integrity. Every single fortress has a weak point, and that 10% pre-market drop tells me Wall Street thinks they found one. So I think it's time we stop looking at the shiny facade of 2025 and start stress testing the blueprints for 2026. Let's see what the market is so darn afraid of.
And here it is, the smoking gun. This single slide explains that entire 10% drop. On the left, you've got the glorious past, 19.9% growth in 2025. That's the number they were just celebrating. But on the right, you have the future they're forecasting. Full year 2026 guidance of just 10.5% to 11.5% growth. Look, the market doesn't care about what you did yesterday. It only cares about what you're going to do tomorrow. And what this slide shows is a company that is about to slam on the brakes hard.
Let me really hammer this point home for you. Don't let that positive number on the right fool you. A move from almost 20% growth down to 11% growth isn't still growing. No. For a high multiple stock like BSA, that is a catastrophic deceleration. We are talking about the rate of growth being cut almost in half. To a growth investor, that is a massive flashing red flag. It suggests that the peak is in, that the best days of that incredible acceleration are behind them. This is the crack that the market saw, and believe me, it's a big one. To a growth investor, this is the sound of a screeching halt. The party's over, and they are all heading for the door.
And if that forward guidance is the first crack, well, this is the second one. Over 178,000 shares sold by insiders in just the last 3 months. Now look, insiders sell for all sorts of reasons, but when you see a significant volume of selling right before the company guides down its own growth rate, it raises some really serious questions. These are the people with the most intimate knowledge of the business. They're the architects, the engineers. If they truly believe the company is well positioned to continue on our strong growth trajectory, then why are so many of them cashing out their chips? These are the folks who know the company inside and out, and if they're quietly heading for the exits, it makes you wonder what they know that we don't.
You're focusing on a single crack while completely ignoring the mountain it's a part of. Forward guidance is just a prediction. Insider selling can be noise. You know what isn't noise? The financial bedrock of this company. Before we condemn this entire structure based on a forecast, we need to run a full diagnostic on its foundation. We need to look at the balance sheet, the actual tangible strength that has been built up over years. So is this company built on sand, or is it built on solid rock? Let's find out.
So how do we actually stress test this foundation? Well, we use a really powerful tool called the Altman Z-score. Think of it like a structural engineer's report for a company's financial health. It combines a bunch of different financial ratios to produce a single, powerful score that predicts the likelihood of bankruptcy. Anything below 1.8, that's the danger zone. Anything above 3.0 is considered safe. It's a battle-tested, proven metric for assessing durability. And Boston Scientific's score? A massive 5.24. Now, this isn't just in the safe zone. This is deep in fortress territory. This score screams financial stability. It tells us that the company has an exceptionally low probability of any kind of financial distress. So while the market is out there panicking about the growth rate next year, the underlying financial structure of this company is made of reinforced steel. This company is built to last. It can withstand market shocks. It can withstand economic downturns. This is the bedrock. And it's not just that one number. The entire foundation is solid rock. Just look at these other metrics. A debt-to-equity ratio of 0.52, that means their debt is highly manageable, they are not over-leveraged. A current ratio of 1.51 shows really healthy liquidity. They can easily cover their short-term bills. And then you've got the Benish M score. This is like a forensic accountant's special tool, designed specifically to detect if a company is manipulating its earnings. A score like -2.48 is deep in the safe zone, which gives us high confidence that those incredible earnings we just saw are real. The books are clean. So what we have is a company with super low bankruptcy risk, manageable debt, plenty of cash, and trustworthy accounting. That is the definition of a sound foundation.
So that brings us to the final weigh-in. We have the bull case, a company with a proven, indestructible foundation that's just coming off a record year. And the bear case, a company whose best growth days might just be behind it, with insiders trimming their positions and a market that is clearly spooked. The question for every single investor watching this is simple. Is the stock's sudden drop a warning sign to stay away, or is the market just overreacting and creating a massive buying opportunity?
Now, it's not just our analysis that's pointing to strength. Let's bring in a third party. The heavy hitters over at RBC Capital Markets have looked at the very same data, and they've set a price target of $130. Based on the price when they wrote their report, that implies a potential 36.3% upside. I mean, this isn't some tiny upgrade. This is a major vote of confidence from a serious institutional player, and it suggests they see this dip as a clear opportunity.
And look, their target isn't just based on wishful thinking. Let's break down their math. They're using forward-looking multiples, looking all the way out to 2027. They see a PE ratio of 30, which is significantly above the company's 10-year historical average of around 24. So what does this mean? It means RBC believes that the company's growth, even at that slower guided rate, justifies a premium valuation. They are betting that Boston Scientific's market leadership and its innovation pipeline will continue to command higher multiples than its past performance. They believe the foundation is strong enough to support a much taller building.
Okay, let's put it all on the table for the final weigh-in. The bull case, the foundation, is built on the undeniable facts of a record 2025 performance, a fortress-like balance sheet with that Z-score of 5.24, a dominant position in its market, and a strong buy consensus from analysts who see significant upside from here. The bear case, the cracks, is all built on the future, a major, undeniable slowdown in the growth rate that's guided for 2026, that cautionary signal of insider selling. An evaluation that, as RBC's own numbers show, requires you to pay a premium and believe the best is yet to come, even as the numbers start to slow down.
So, what is the iron financial verdict? Well, the market's fear is understandable. A 50% haircut to your growth rate is a shock to the system, and for a market that is obsessed with acceleration, it's a massive red flag. It rightly asks the question, is the heavy lifting phase of hypergrowth over? But the key question is whether that shock justifies a 10% demolition of the stock price. Is the market correctly pricing in a new, slower reality, or is it just panicking, throwing away a rock-solid company because the future isn't quite as spectacular as the immediate past? And that's where we land. Our analysis concludes that the foundation is far more important than the forecast. The fear of a peak has created a value opportunity. The growth slowdown is real, yes, but it's a slowdown from an unsustainable, exceptional sprint. A company of this size growing at a projected 11% is still a powerful, healthy engine. The market is pricing this as if the engine is failing, when in reality it's just shifting down to a more sustainable marathon pace. The Altman Z-score proves the company is durable. The balance sheet proves it's responsible, and the analyst consensus shows that the smart money sees past this short-term noise. The structure isn't crumbling, it's settling after a period of explosive construction. For the investor with the discipline to look at the financial bedrock instead of the shifting clouds of guidance, this sell-off looks less like a trap and a whole lot more like an opportunity to buy a best-in-class company at a discount. The foundation is solid.